Hello out there, traders, and welcome to the Tackle Trading Options Report. This is the one and only Coach G. Just posted the next week's option report. Last week was a phenomenal week, just a phenomenal week. I have to brag real quickly. Just recap a few trades of the past option trades we've been doing here at Tackle Trading. Let's see, Expedia. We cashed out of this one. This was a home run. We had a put spread on this one. We bought some puts and got out of pretty much all of them because this was more than a home run here. I think we're holding one or two contracts or something like that. But here we are here. You can see we just nailed this one. We caught the breakout, or maybe I should call it a breakdown here on this long bearish flag. Look at this run, guys. Look at this run. Home run. Well over 100% return on our put spread. Hope you guys enjoyed that trade. That was posted on our adjustments. Here is Autodesk, another put we bought here, another long put trade here. You can see the moving average was violated, the nice triangle being broken down. We entered right here last week and just nailed it. Great trade. Nice little return on that one. And here's another one that was kind of weird. This is actually a bullish trend. This is Computer Sciences CSC. Now the reason is they were split adjusted. They were right here at the beginning when we were looking at this last week, and look at this breakdown. Look at this breakdown here. Still, we actually got out of this right at the moving average, but if you stayed in it, major home run on the puts. Not my favorite setup, but it worked out. Here's one that was a no-brainer. Here is Triple M, 3M. Had a hard time getting over this triple top, broke through this triple bottom. Here's your kiss of death right here. Came up. We saw, or actually I saw this kiss of death formation right there, a little swing high. And all week just panned out nicely. Triple M, another home run on the put side, did real well. So guys, that's the option report. That's up to date what we did last couple weeks. Now, what's going on lately? What do we have for this week coming up? As you know, last week was a down week, the first week of the year. What a horrible week to start out the week. Horrible for the market, great for us because, like I said, our put spreads and our long puts really paid out. Here's the market. What I'm seeing here is a definite bearish channel, slightly bearish, but look how it accelerated to the downside here. Look at how this really started breaking down over here, and we haven't found a bottom yet. The bottom's way over here. So yes, the market's overextended, and yes, there's still room for it to go down. I'm expecting a big bounce. When that's going to happen, I don't know. I'll tell you after the first day up. That's probably the start of it. Till then, overextended market could go either way. It's definitely bearish. So how am I playing it? Well, I am favoring the bear team. So if you come over here to the option reports, I'm favoring the bear team, but you could get stopped out real easily because there's going to be a short squeeze. There's going to be a dead cat bounce. So here's the option report. Let's dig into it. Let's read more. You can find this on the front page, recent post. Here we are. DRI is my favorite for the bull team. Was jumping to DRI. What do I see there on DRI? I see a bullish trend. Here we go. It's been bullish all through here. Here's your channel. My trigger's right above here. Trigger's right above here. You'll notice to buy calls. And our stops down in this area. If it doesn't trigger on the upside, then that's okay. We won't be filled. So you're going to see a lot of resistance here too. So when it clears all this resistance, there's my trigger on the upside. That's DRI. The next bullish team is DG, otherwise known as Dollar General. Dollar General not participating in the market sell-off. Check this out. A lot of resistance here, so we got a trigger above that. A lot of resistance in this bullish triangle. Very strong. The rest of the market is tanking and going down, but Dollar General is holding in there. By the way, a lot of shopping will be done in the Dollar General if the economy goes bad, so maybe it's setting up for that. Do notice the relative strength is above 50 here, very strong, but the volume is below the moving average, showing it needs some buy volume to come in. So by the time we get triggered up here, this volume down here will come in, And that'll be a perfect setup for a breakout there. Now, Dollar General. And that's the last one on the Bulls team. Who is on the Bears team? Here we are, CLGX, otherwise known as Core Logic. Nice downtrend. Look at this nice downtrend here. Look at this nice channel. A lot of room to the downside. This could probably go down to the 3250 on the next leg down. Again, not only is it in a down channel, but it has been relatively weak back here, and the volume really got weaker right there. So volume on the downside, bearish trend, good candidate for puts. That's Core Logic. Next one up to bat for the Bears, M. Big M. Macy's. Macy's. Here we got a swing high. Or excuse me. Let me draw the channel there first. Here's your channel. Notice I'm starting at the gap. That's the new trend. You could start at the gap. There's our swing high. Do you guys see that right there? Boom, right there. It tried to hold above the 20-day moving average. It failed. We got our trigger right below all this support in here. So there's my trigger to buy puts. Now what I'm looking for is when it breaks that area. Definitely relative strength is weak, but check out this volume. I need the volume to pick up when it triggers there. I'm going to be making sure that when I get into this trade, this line down here, this on balance volume, breaks that moving average right there. Most likely it will, because volume's already starting to pick up. Love it. That's Macy's. Now, if you scroll down the list, you'll see credit spreads. There's a lot of them out there. Just I'm not real happy with the options, the way they're setting up. Buffalo Wild Wings, BWLD. Look at this. They tried to fill the gap here. Here's the gap area. They tried to fill it. They stopped short here, and they're already downtrending from that. So let me draw that in there. Already downtrending from that. So not only do they have all this overhead resistance of this down channel. Look at that perfect channel there. It's an expensive stock. We're sitting here in the 155 area. Now, I think there's a lot of resistance, not only at 162, definitely resistance here at 165. And then you got resistance on this gap. So how do we play this? We're selling. If we get the credit we want, we will be selling the bear call spread at 185. That's 30 points higher than it is right now. So it's got to get through all that resistance, which I don't think is going to happen when the market's bearish. Now, earnings is coming up on a lot of these companies, guys, so stay tuned, especially if you're in a bear call spread. I'm trying to get 75 cents or better. I might be able to get 90, depending on which way it moves. If it moves up Monday morning, a good buck or two, I'll probably get a good $1. But yeah, I'd even settle for 70 cents. I'm not going to be in this past earnings. I'm probably just going to close this down. Heck, I'll be happy selling this for 75 and buying it back for 60. I do not need to let this expire. Biggest mistake people make on credit spreads, and you heard it here from the Theta Maker, is trying to take your credit spread to expiration. By the way, I know a lot of people, and I do it sometimes too, I'll sell them 45 days out and buy them back 2 weeks from now for about 30 cents less, and very successful. Never have to worry about those, because taking it to expiration means you're really greedy trying to get that last nickel. You guys, credit spreads, most of them, you don't need to take them to expiration. There's even people out there that scalp these. They'll sell them for 75 cents and buy them back the next day for a dime less. Now, I'm doing a lot of contracts, but that's called scalping the credit spread. Lastly, we have debit spreads. These are ones we're buying because there's low volatility on these options. Domino's Pizza. Domino's Pizza. Why are we doing a debit spread on this? Because you see how it's starting to break out of this area here. It doesn't know which way it wants to go. See this? Domino's Pizza it broke down right here. It broke down. It's trying to recover. It's stuck under the 20. This could go either way. Volatility is low. But what are we doing on this trade here? We are doing the long 105 by 100 put spread. So if it drops, we're okay. And we're doing a long 115, 120. Notice the long leg on the put is at 105. The long leg on the call is 115. That gives it 10 points to move between now and February, which is about 6 weeks out. It's definitely going to move 10 points in one direction or the other. If I could get in there for 220 or less, I'll be happy. Max profit will be 230 because you can only make $5 in this. So it is a possible money doubler, but I'm not trying to double my money. I'm just trying to make easy money with high probabilities. CMG, what do we have here? Chipotle Mexican Grill. A lot of E. coli and different things going on with this company. Looking at their fundamentals, it's horrible. Earnings is coming up on this, but look at how this channel is accelerating to the downside. Look at that. So what am I doing? On CMG, I'm buying the 390 by 380 put spread. That means I'm buying one way down here. But to make it cheaper, I'm selling the 360 by 350 against it to bring in a credit. So I'm selling the one even farther down here on the graph. So I have a debit here and a credit here, which is your debit condor, which means I can do this, play the downside, because I think there's a lot of downside left with really bad fundamentals and the problems they're having with their stores and having to close them. I could get in there for $1.65 on a $400 stock. I mean, that's just incredible. Look at this. $411, $412, and I'm playing the stock for $1.65 roughly. I wouldn't even mind spending $2 on this because the max profit is you can make $10. So if I spend $2, I can make $8. If I spend $1.65, I can make $8.35. Great risk reward, great way to play an expensive stock for very little risk and very little money. That's called a put condor. That's using puts to create the entire condor. That's a long spread and a short spread. Put it on a graph, check it out. It's not that hard. Practice these if you're brand new. And by the way, we have the risk calculator in here. You can just input your risk right here on the top after you download it. We have the bulls and bears ready for you to input. You don't have to take our recommendations. This is education only. Tackle Trading LLC is providing this and all of its materials for educational purposes. Please visit us on the Coach's Show and keep up to date with our daily adjustments. This is Coach G reminding you, get in the game and stay tuned to Tackle Trading.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.